Imagine being able to earn interest backed by real estate without buying the property, dealing with tenants, or taking out a loan. It sounds like something only banks or hedge funds get access to, but for decades, ordinary investors have been quietly making money through something called tax liens. The problem is, most people either misunderstand how the system works or never hear about it at all. So today, let's break down Tax Liens 101, how the game actually works, why counties sell these liens, and how investors use them to generate returns backed by property.
Let's start with the basic question. What exactly is a tax lien? Every year, property owners are required to pay property taxes to their local county government. Those taxes fund things like schools, roads, fire departments, and public services. But every year, some property owners don't pay their taxes. Sometimes it's financial hardship, sometimes it's neglect, sometimes they simply forget. When that happens, the county still needs that money to operate. So instead of waiting months or years for the homeowner to pay, the county sells the right to collect that debt to investors. That right is called a tax lien. Here's where things start getting interesting. When an investor buys a tax lien, they are essentially paying the homeowner's overdue property taxes to the county. In return, the investor receives a lien on the property. That lien means the homeowner now owes the investor the unpaid taxes plus interest. And depending on the state, that interest rate can sometimes be surprisingly high. In some counties, rates can reach 10%, 12%, even higher. But the important thing to understand is that the investment isn't backed by a promise from the homeowner. It's backed by the property itself, which means if the homeowner fails to pay the lien within a certain time period, the investor may have the right to begin the foreclosure process. Now, before people get the wrong idea, that doesn't mean investors are immediately taking people's homes. In most cases, homeowners pay the tax lien long before foreclosure ever becomes a possibility. And when they do, the investor simply receives their original investment back, plus the interest that accumulated during that time. Think of it like a government-managed system for collecting unpaid taxes. The county gets paid immediately. The homeowner gets time to repay the debt, and the investor earns interest in the process. But this raises an important question. If this opportunity exists, why doesn't everyone do it? The answer is that tax lien investing isn't as simple as buying a stock. Each state has its own rules. Each county runs its own auctions. Some states sell tax liens. Others sell something called tax deeds, which is slightly different. And there are also risks involved that many beginners don't fully understand. For example, not every property tied to a tax lien is valuable. Some liens are attached to abandoned land. Some are attached to properties with environmental issues, and sometimes investors win liens that take years to resolve. That's why experienced investors spend time researching properties before participating in tax lien auctions. They check property values, they look for other liens on the property, and they analyze whether the investment makes sense relative to the potential return.
Hey everyone, sorry to interrupt this video, but real quick, if you want to take full advantage of tax liens and deeds and you don't know where to start and you want the full blueprint of how to make money in these auctions, how to register them, bid on them, make money from them, and get that mailbox money yourself, links down below to the entire program, and I'll throw a sale link down there so you can take advantage of this right now. Now, back to the video.
Another thing many beginners don't realize is that tax lien auctions can be competitive. In many counties, investors bid against each other by lowering the interest rate they're willing to accept. For example, if the maximum interest rate is 18%, investors might bid that down to 10% or even lower, depending on demand. The lower the rate you're willing to accept, the more likely you are to win the lien. This creates a market where experienced investors try to balance risk, return, and competition. Now, one of the reasons tax lien investing continues to attract attention is because of its unique position between real estate and fixed income investing. On one hand, you're not managing property or tenants like a traditional landlord. On the other hand, the investment is tied to a physical asset. That combination is what makes tax liens interesting to many investors. But it also means you have to understand the process before jumping in. For example, investors need to understand redemption periods. A redemption period is the amount of time a homeowner has to repay the tax lien before additional legal action can occur. Depending on the state, that period might last months or even years. During that time, the homeowner can repay the taxes and interest at any point, and when they do, the investor gets paid. But if the redemption period expires without payment, the investor may be able to move toward foreclosure or ownership depending on the state's laws. This is why understanding your local rules is critical, because tax lien systems vary widely across the country. Some states strongly favor homeowners, others provide more leverage to investors, and learning those details is one of the biggest parts of the strategy. So let's step back and look at the overall picture. Tax liens exist because counties need a way to collect property taxes quickly. Investors step in to provide that capital. Homeowners are given time to repay their debt. And if everything goes according to plan, investors earn interest while the county maintains its tax revenue. But like any investment strategy, success depends on understanding the rules of the system, researching properties, and being selective about which liens you pursue. Because while the concept may sound simple, the real advantage comes from knowing how the game actually works. If you found this breakdown helpful and want more content explaining strategies like tax liens, real estate opportunities, and how different financial systems actually work behind the scenes, consider subscribing. And if you want to go deeper into this topic, check out the next video on your screen where we break down the biggest mistakes beginners make when starting with tax lien investing. Understanding those mistakes ahead of time can save you a lot of money and frustration. I'll see you in the next one.